Ladies and gentlemen, we think that it's essential to have private enterprise in banking as well as in insurance with a healthy cooperation but not dominance by the government in order for economies not only to thrive but for them to efficiently recover. Therefore, we think nationalizing financial institutions like banks and insurance destroy economies, also subject them to government inefficiencies and also politicization. We think it's a large and massive loss of analysis inside opening government to analyze political structures as well as governmental structures that inherently make these banking institutions inefficient if they were subject to nationalization, and we think that's a fault on your side. What do we support? We support things like the Glass-Steagall Act that separates in financial institutions, separates money for investment as well as monies for people's saving in order to ensure that banks can't use people's saving in order to make risky investment. We are also happy to repeal Citizens United that allow banks and financial institutions the ability to lobby and things like that. We are also happy to stand for stronger regulation and accountability in the private sector. We are also okay with breaking up banks that are too big. We are also okay with things like both having public and private options for insurance companies. The point is that we are okay with regulations and we are okay with banks being regulated as well as insurance companies. But what we want essentially is a balance between the two, in which government needed to defend a world in which there is complete government control on these institutions. Therefore, most of the weaknesses of government are then subjected onto these large financial institutions as well. What are these problems? Firstly, we say that then they are immediately subjected to things like most inefficiency of nationalization. What are these things bad for? We think nationalization are bad for two things. First, economic development and prosperity, no thank you, as well as economic recovery. Firstly, we think that in terms of economic development, we think that it's a huge disincentive for investors as well as businesses to establish and expand their businesses in states that have nationalized banking institutions and financial institutions. The reason is because the nature of the private sector, that banks are able to make risky investment for new technology, uncharted technology, and businesses that are new and innovative, ensures that an economy never remains stagnant and an economy is able to function like it should. However, on their side, governments are always beholden to never take risks. Therefore, the risk-averse argument on their side actually works against them because that means that right now there are no other financial institutions that are able to undertake risks to establish new institutions and establish new businesses. On our side, we recognize that the government is able to do things like make not risky investment, but on our side, we also have private financial institutions that are able to make those risky investments in order to ensure that the economy never remains stagnant and are able to develop. Nextly, we also think that they're good for things like economic recovery. Why? We think that in a context of post-financial crisis, the financial sector is extremely important. But during an economic failure, the immediate person that individuals started blaming are the government. Because you stop trusting the government to take over this bank. That means that most of the inefficiency and political repercussions are almost immediately undertook by the government. But for a financial institution, because of private autonomy, it's far easier for them to regain confidence by things like reforming or changing their board of directors. That's because people are confident that they have market incentive to remain efficient regardless. But people are never confident that the government will remain uncorrupt over the post-financial crisis, or that the government will not have the same political weaknesses that they previously had, or not subject to the same voters with the same discriminatory bias or things like that. So it's far easier for us to move out of an economic crisis on our side. No, thank you. Furthermore, and most crucially, we also think that financial institutions that are nationalized are then subject to political agendas and are far easier politicized on their side. Things like cronyism, corruption, and ideological agenda are things that they now subject the economic institution towards. Firstly, we think that it most crucially scares off investors. For example, voters in the third world countries that largely believe in anti-Western propaganda might believe that Western businesses have no part in their economy, which is an inefficient policy for banks and financial institutions to institute. So if they never foreign investors into their country, we think that's generally economically inefficient. The difference here is this, right? Private autonomy ensures that there's no political obligation on the part of private financial institution to uphold the country's ideological agenda. So if you're indeed a country that's oppressive or a country that believes that foreign people have no place in your economy, that same political obligation is not subjected onto financial institutions that are inherently private. But the voters can hold government accountable to such things, and we regret that. No, thank you. Secondly, we also think these hurt oppressed groups or minority groups in countries that have discriminatory policies. For example, in Malaysia, where the government largely favors the majority group, which are the Bumiputras and the Malays, that means that the country or the government now have complete and full control over the economy of these minority groups. They are able to exclude them for that moment.
Glass-Steagall was repealed because of the political influence of the banking industry. How do we keep the regulations you want permanent without taking the banks out of the hands of those who wield that influence?
We can reduce the amount of powers that large banks have. Things like breaking up big banks, things like ensuring that banks who have too much influence don't continue to have too much power or too much influence. The debate then crucially isn't necessarily about that, but whether or not we want to have some degree of privatization in the banking industries if we're able to regulate those powers, right? So comparatively, we also think that private institutions are less discriminatory because they operate on market incentive rather than operate on political incentive that largely oppress a large amount of people, right? Having governmental control over your economy is bad. But more importantly, and this is also in reaction to what they said, that whether or not we're able to hold these institutions accountable. Because they said they were not able to hold big banks that are too powerful accountable. But we think that on their side, if banks are too big and bad, they will fail naturally due to market incentive. But if a government is in control of a bank that is failing, they have every incentive to ensure that they pump up that bank regardless of their failure and their inefficiency onto the government. The same way they do for GLCs. We're incredibly proud of it.